Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Mobile home parks and self-storage properties have historically been the top-performing asset classes across multiple economic cycles, including severe downturns. Paul Moore is the managing director and co-founder of Wellings Capital, a real estate fund specializing in mobile home parks and self-storage assets. In real estate, Paul has completed 85 real estate investments and exits across many asset classes, including hotels, multifamily, and even in online real estate marketing. Paul is also completing his next book, Storing Up Profits in the Self-Storage Sector. Paul will share with us the many secrets to those two asset classes and why investors, both passive and active, may want to include them in their portfolios, especially in today's uncertain times.
Yeah, so a bit of housekeeping. This is not an investment platform. We're essentially a learning platform, and so we're not providing investment advice. This is really a research and learning event. And again, thank you. And I'm very excited to have my friend, my pretty recent friend, Paul. We met in February, but I really am excited to have him here. So Paul runs Wellings Capital out of Virginia, and they're really one of the rare funds out there that focus on investing in self-storage parks and mobile home parks. And I'll let him talk more about that. I came across Paul and I reached out to him, and then I drove up to Fairfax to see him because I really enjoy his writing. I think Paul has this knack for explaining concepts in a very well content, but also a very simple way. And so I reached out to him, and he was kind enough to took me to lunch. And we're here today. So Paul also has a book called The Perfect Investment that talks about multifamily. And in case some of you guys are interested, that Paul has a background investing. Many years of experience investing in real estate, multifamily, but again, he's now focused on the self-storage and mobile home park space. So today's event, what we want to focus on with Paul is really a few topics. One is recently Wall Street Journal published a front page news that said, in fact, let me come back to share this thing. Again, I apologize today. I must have been in Florida a little too long. But this is essentially what Paul has been doing. This would blow you away. I'm not sure if any of you guys see this article. But essentially it talks about, this is a February article, talks about what these two asset classes, self-storage and mobile home parks, have returned for over 4,000% since the housing crisis. Really, it's almost like a dot-com technology return. And again, this is exactly what Paul is doing. He's a pioneer in this space. And I wanted to hand over to Paul to maybe, Paul, if you could just share with us a bit of a background in your own words, how you came to this, and given so many years of experience of researching, writing, and doing real estate, why you're now focused on these two asset classes, if you don't mind. And we need to, 1 second, I need to unmute you. 1 second, Paul.
Okay, how's that?
Okay, that's good, perfect, thank you.
It was on my end. So I hate investing in mobile homes.
Okay.
I actually invested in mobile homes like three or four times over the years. And of the almost 100 real estate deals I've done personally, they were 3 or 4 of the worst deals. Actually, it's 4 times. I just remember the 4th. And 3 of them were the worst deals I have ever done. But I love investing in mobile home parks because mobile home parks is essentially a land lease. We're leasing land and we're cooperating with the tenants who are bringing their own mobile homes. So yeah, I love mobile home park investing. I wish I'd have got into it earlier. I had chances back in the late 90s. And of course I turned my nose up at it. And then I real smartly invested in 4 mobile homes instead. And 3 of the 4 ended like total disaster for me personally and, economically. But I won't get into that tonight unless somebody asks me later. But what I really love about mobile home parks and self-storage and multifamily is that, they're commercial real estate. I was doing residential real estate for years, and I kept hearing that the smartest, wealthiest people in the world invested in commercial real estate. And I didn't really know why. I didn't know how to get in. I didn't know who to trust or where to start. And I finally got thrust in. I was investing in oil and gas in 2010 in North Dakota. And my buddy who had a jet, he was my long-term business partner. He had a small jet. And every time he would fly there, we couldn't find a place to stay. And we had to fly back out of North Dakota because of the big Bakken oil boom. There were 19,000 job openings. There were people parked in Walmart and all along the side of the road, trying to find a place, to sleep for the night before they worked their next 12 to 16 hour shift. And so we built a multifamily facility, and I found a little bit about my experience, why people like commercial real estate investing. But it was years later when I was ready to write a book on multifamily that it really sunk in. And the reason commercial real estate is so powerful is the value formula. If you invest in residential, you can buy a $300,000 house. And I just read an article moments ago talking about the number of foreclosures that are going to be hitting, especially in 2021 and 22. It's going to be potentially massive. But if you invest in a residential house and let's say you buy it for $300,000, you add like gold-plated fixtures. I'm being ridiculous, Sam. Finish the attic, finish the basement, add additions on. You got $800,000 in it. If you're in a $350,000 neighborhood, you're not going to get your money back out of it because residential real estate's based on comps or comparables. Commercial real estate's entirely different. It's based on math. The math is very simple, and it's similar to stocks, to a PE ratio, but the value is the income divided by the rate of return. More specifically, the value is the net operating income divided by the cap rate.
Sure.
So if you can do things to expand the numerator, the net operating income, or if you could possibly contract the denominator, lower the denominator, the cap rate, you're going to be able to significantly increase the value of the asset. And then if using safe leverage, you can compound the value of the equity. And so, if you like, I can just go through a quick example of that with a mobile home park.
I think the group here probably have some background on the cap rate and the math. Maybe you could. I'd love to hear more about your views on the different commercial real estate asset classes as we discussed earlier, and again, why specifically your fund in these 2 asset classes.
Yeah, you bet. So I wrote the perfect investment. It's a very humble title, right, Sam? And
yes.
The perfect investment's not so perfect if you can't find deals that make sense. So we spent 2015, 16, 17 into 18 looking for deals that made sense, where the math worked. We were outbid continually, and we found that lots of people, I'm not saying they were all newbies, but some were. And we found lots of people who were being, a little bit, I don't want to say, how do I say that? They were taking a lot of risk. They were overpaying for assets. They were $5 million deals that just did not pencil above 5 million, where people were paying 6.5, even 7 million for that deal. Now, that's really serious. And we weren't willing to do that. And, the lenders were they were going along with this. They were valuing these, assuming the appreciation would kick in, assuming the rent growth would work. And so we love multifamily, and I could give you an hour-long discussion on why it's one of the best asset classes, but it wouldn't be a great deal if the math didn't work. So we started in early 2018 looking for other asset classes, and we really felt like we were near the top of the market. We'd had a record long bull, bull run in the economy. And so we started looking for assets that made sense in a downturn. And we found that self-storage and mobile home parks had done very well during the last downturn. One of the leaders in the self-storage industry said that self-storage was second only to liquor in the great financial crisis, the GFC of 2008 to around 2011 or 12. Mobile home parks were the only asset class that had no noticeable dip in net operating income on an asset level basis in the last recession. So we really liked both. And so we spent 2018 investing in some of those deals. And then in 2019, we set up our first of now 3 funds to invest in mobile home parks and self-storage. One thing we love about mobile home parks is, and you probably all know this, or most of you probably do, I know Arun does, it's the bottom rung on the housing ladder. And so if somebody gets bounced out of their 4,000 square foot home, they might go to an apartment. Somebody gets bounced out of their 2,000 square foot home or apartment, they might go to a mobile home. If they get bounced out of that, if they can't afford the rent, which is, something like half or a third of an apartment for more space and a little yard, they're probably going to end up under a bridge. And so mobile home parks, I don't know that this will continue, Sam, but right now, a lot of the mobile home parks we're investing in and talking to say they're getting growing lists of growing waiting lists.
Wow.
Of people wanting to move in, anticipating this downturn. I see Arun's nodding.
Paul, can I just push that a little bit? I'm involved with this guy, Brad Sumrock, as you know him, and I have a few of my fellow students here, Arun and Dave and a few others, and we primarily focus on C and B residential, as you know, right? And every week or two, we get together and talk about collections. So as of March, April, May, what we're finding is A's are better than B and B is better than C so far in terms of collections.
No, I didn't know that. That's good to know. That's in apartments?
Residential, multifamily residential apartments. Certainly within our group, and I think the group, Dave and Arun knows a bit more, but I think within the group, the students are collectively own tens and thousands of units just this year alone, mostly in B's and C's. And again, twice a month we get together and we said, what's collections? And seems like B's doing better than C and A's doing better than B so far as of May. Yeah. So I'm just curious what type of collections you're seeing in your asset classes with your portfolio deals.
Yeah, I could pull them up, but I'll tell you, and again, I don't want to represent that this is going to continue this way because I don't really necessarily think it will. But right now, collections in mobile home parks and self-storage are actually slightly ahead of normal. At least in the deals we're doing. Now that's in one operator. We have one operator who we put the vast majority of our investments with. They're ahead of schedule. Honestly, the other 2 operators are saying that they're both slightly behind schedule. And so I would say on the balance, they're somewhere, somewhere near normal. Let's put it that way.
So COVID's a bit strange because we have the subsidies and the $1,200 checks, right? And what, in your experience from the past recessions, more prolonged recessions, how's the performance when you take a longer view in a recession? Because recessions don't last 3 months, right? They typically last years and years, right? Yeah, I think in my brief researches, they seem to have done well, but I'm curious if you could kind of talk to that.
Yeah, so self-storage had a brief dip in 2009 last time, and then it shot up and it really grew tremendously from 2009 to right up to this year. Mobile home parks had no discernible dip in the graphs I've seen at all, and they've continued to grow more. As you mentioned in the Wall Street Journal article, the returns have been phenomenal. One way, I just want to comment on this really quickly. Oh, no, I want to go back to self-storage. Self-storage, I think, has more risk in the upcoming recession because it's been overbuilt. Self-storage has been overbuilt. So I could take you to neighborhood after neighborhood, submarkets of Nashville, for example, and show you why there's too much self-storage. I could also take you to southwest Nashville, Belmont, Bellevue area, and show you why there's a huge need for self-storage and it's underbuilt. So it's very submarket specific. Mobile home parks aren't that way at all. That's the only asset class I know that has a shrinking supply and an increasing demand every year. There are about 44,000, we believe, mobile home parks in the US, and about 40,000 are owned by mom and pop owners who don't have the desire, the resources, or the knowledge to really upgrade them, to bring in more, to fund bringing in more mobile homes and to get them to top performing, top level income. So a lot of these can be purchased for a very fair price, bought from the owner, and then upgraded with 3 or 4 or 5 simple changes can be significantly higher income and therefore very, very much higher value based on that value formula I mentioned 10 minutes ago.
Sure. So Pause Fund is really, you don't invest directly, you invest in operators of these mobile home parks. So maybe you could just, for those of us not familiar, can you talk us through a typical deal size, the economics, what's the value add, what's the exit, and what type of returns one could expect for the operator, but also for the passive investors?
Yes. I'm going to get my calculator here just in case. So in January, we went to Louisville to look at a mobile home park we were going to invest in. It was the owner had passed away 5 years ago. His wife had never visited the park in 5 years since then. She was 2 or 3 states away in Georgia. And this was in Louisville, Kentucky. It hadn't been, the lot rents hadn't been increased. I think it was 311 pads. So the lot rents were 20 to 25 or even 30% below market, number one. Number two, the owner, the company, was paying water and sewer, possibly trash as well. And so they were eating that cost, and that was $213,000 a year. And number three, there were 50 vacant pads. And so I believe that was, I don't know, something like 15% vacancy, if I'm not mistaken. And so the owner's plan, well, first of all, the owner, the seller said that they had bids up to $9.5 million, but my guy, he bid $7 million, and they said, we'll do it for 7.1 because they just wanted a very simple deal. It was a cash deal. He was in position to do that. Once he put the press release out on February 21st that he'd acquired this, he got an offer for $9.5 million, the same high offer before from the same person from Texas, and he turned it down without a counteroffer. Now, why would he turn down a huge profit like that, $2.5 million almost in a week? Well, here's why. Number one, he thinks he can probably fill one vacant lot a month. So in 3 years, he's going to be able to fill approximately, let's just say 30 to make it simple, 30 lots at $300 a month. That's $9,000 a month. That's $108,000 per year. He's going to add to the bottom line. You divide that by a 6% cap rate, and that's $1.8 million he could add to the bottom line. Now, it's going to be a lot of cost and hassle to bring those units in. And Arun knows this. Now, the second thing he's going to do is raise the lot rent by just a modest amount, maybe $25 a year to bring it up to market for a couple of years. And so that's, let's just say $50. He's going to raise the lot rent times 280 lots. That's 14,000 a month. And he's going to multiply that by 12 months. That's 168,000 to the bottom line. And if you put that with a cap rate on the value formula, that's another $2.8 million in value. The third thing is he's going to sub-meter every lot and every mobile home. And that's going to save him $213,000 a year, which if he passes that back to the tenants, that's an additional 3.5 million in value. And so I didn't keep track of those numbers, but it's something like 6 or 7 million in additional value. So what he did,
Wow.
yeah, so he spent 7.1 million on it, and let's just say it's worth 12 million when he finishes those three things, and let's say that's over 3 years. Well, I mean, if he put 4 million in debt on it and put 3.1 million in equity, which is I think what he did, that 3.1 million in equity, the bankers don't share that upside. If that $5 million increase does come in as planned, the equity on that just went from 3 million-ish up to 8 million-ish. And so that's a pretty nice return in 3 years. The way he shares that with the equity owners is, so that 3 million becomes 8 million. Again, I'm not going to do the math on that because it's all an estimate anyway, but you get the idea. The equity holders, the cash investors, in other words, they're going to get the first 8% a year, which is an 8% preferred return. And then they're going to get, we as a large investor at least, are going to get an 80-20 split above that, which means we're going to get 80% of the profits above the 8% preferred, and he's going to keep 20%. Now, when he refinances, again, let's say he refinances with Freddie or Fannie debt in year 3 or 4 and holds on to it, that might shift. If he hands the investors back their 3.1 million, which he probably will, that will eliminate the 8% preferred. But we as investors will still get an 80-20 split. We'll still get 80%. So that's how the math works on that, Sam.
Okay. So I think most of us here are familiar with the multifamily apartment syndication. So it sounds to me that the valuation and the NOI increases are similar. Now, in this example, the houses on top, you talk about lots. The operator doesn't own the home, right? The tenants own that, or who actually owns the asset on top of the land?
The goal in this business, and again, for those of you who were on when I started, I hate investing in mobile homes specifically. I like to invest in the land, and I think Arun, I would guess, feels the same way. I shouldn't speak for him.
No,
but,
absolutely.
Yeah.
We go after parks which most of the homes are owned by the residents. I mean, we may have a very small percentage, but
right.
We try to sell those.
Okay.
Right.
So it depends, but you prefer the parks where you're really just the land and the infrastructure, utilities, and the tenants are the owners themselves, right?
Yep.
Okay.
Yeah. So the goal is to, as soon as we get a mobile home, I mean, if we can get a used one and haul it over there, we will. And because there's like I said earlier, there's a growing waiting list for people to move into these homes. But if somebody abandons one or leaves one or sells one to the park, the goal is to get it back in the hands of the owner as soon as possible. Now, one way to do that is, Warren Buffett has a company called 21st Mortgage, and he actually finances new and used mobile home parks. Of course, the park owner has to effectively co-sign for it, but the mobile home's brought in, and then it's leased to someone, and then hopefully it's a lease to own or a sale to that individual, and it's in the individual's name, and therefore the maintenance and all the upkeep falls on the individual tenant, which is it's a somewhat of an advantage over the apartments I've owned in the past, where sometimes they leave and they trash the place. Now they may trash the mobile home too, but it's theirs.
Okay, so just finishing the comparison versus in multifamily, certainly the larger ones, we have access to these non-recourse Fannie Freddie agency loans, and also a lot of fantastic tax savings, right? I've kind of heard back and forth. Can you talk about those two items for your asset class?
Yeah, so there is, it's the same sort of non-recourse loans.
Okay.
We had done, I should say our operator we invested with did the math on that one at like 4%, 4.5% interest rate, maybe even 5%. And I think when he actually got the debt, he put the debt on it in late March. I think he got 2.99%. And that was,
Wow.
I think it was an interest only loan for a few years and then 10-year fixed, I think. So the debt's very similar. The same guy who did my last apartment building that I invested in as a syndicator at Wellings was the exact same guy who wrote the loan for them and I can't remember if it was Freddie or Fannie. Maybe Arun knows which one it is, but one of them really likes mobile homes. I'm not sure the other one does.
Okay.
Yeah, Fannie does like mobile home communities.
Okay.
They prefer a star. I mean, at least a 2.5 star rated.
Okay. Okay. Good. As far as tax savings, they're quite shocking. And I never dreamed they were this good, but I've got two really quick examples I can give you. Now, one of our operators does this. He'll go in and he'll evaluate the land. And I'm getting toward depreciation here. That's where I'm going here, just so you can have that in your mind. So he'll take the value of the land at about, let's say 1/3, maybe let's say 30% of the cost of the mobile home park. Then he'll say the improvements to the land, which are, maybe the clubhouse, the pool, the fences, the roads, the shrubbery, all that stuff, the equipment. Well, the equipment may be different, but you get the idea. That might be 35%. Wait a minute, where does that leave? What does that leave? There's 35% I didn't account for. That's exactly what I thought when this operator's telling me the story. I thought he must have made a math error. He said that there's also 35% goodwill in his deals. 35% goodwill? Seriously? And so he said that could be depreciated over 15 years. The improvements, the infrastructure could be depreciated over 15 years. And then, of course, the land is not depreciable. So let's take this example again. So 70% of the cost of the mobile home park is depreciable over 15 years. If you ignore the tax law of December 2017, which we'll circle back to, just assume it is 15 years, that's 4.33% per year that can be depreciated if it's a cash deal. But they're usually not cash. Let's say it was financed at approximately 2/3. In other words, 66% debt, 34% or so equity. That means the 4.33% depreciation every year to get the 15-year straight line on 70% of the purchase price. That's actually going to be 11.66% it would come out to be. You can do the math on it. And so that's how much can be depreciated every year. So if you're having up to 11.6% in cash flow every year, you still have a small loss on your tax return every year. So that's one example. There's another one, but that's my favorite.
Okay. It sounds almost too good to be true. What's the catch?
Well, to make it even better, the tax law, December 23rd of 2017, that was signed into law, allows you to take the infrastructure and compress that down into 1 year instead of 15. The goodwill can't be, from what I understand. And so I guess the catch is you're going to have to pay the piper someday, unless you do a 1031 exchange or a Delaware statutory trust or deferred sales trust. You're going to have to eventually pay those taxes and the catch up and all that.
Okay. So let me try to summarize. I think in terms of commercial real estate, what I'm hearing is you've got this tremendous demand, because from one of your brochures or your fund documents, I learned that the average mobile home park, I think the rental for similar size versus, let's say, an apartment building, it's about half, right? It's quite material, and obviously there's a lot of need for lower income housing, and so I can see the demand is still there. And you're saying, unlike the multifamily residentials with mobile home parks, it's quite fragmented. Some 40,000, majority are mom and pops. So there's a chance for you to pick off some of these that are not yet held by the institutions.
Right.
And then where you can add value precisely kind of what you described. And it sounds to me like it has the same capital structure they can get from agency loans, non-recourse. It sounds to me like you've in pretty favorable terms. And then you have the added benefit of not having to deal with the assets on top of the land. You don't own the top of it. You don't own those assets.
Right.
So I mean, it sounds fantastic. So when your operators acquire this type of asset, what are the returns you guys looking at overall at the operator level, not necessarily the passive investor level, which you talked about already?
Well, you know, you guys might hang up on me if I tell you, but we have one operator. We have 2 or 3 operators actually who go for a long-term view, and they're looking at, IRRs, leveraged IRRs in the 15%, maybe 18% range. But we have one operator where we've invested a lot with, who they have been, their goal is to go in year 1, make the type of changes I mentioned a few minutes ago. Year 2, increase the rents and increase the income to where they should be. In year 3, put it on the market for sale. And so their average time to sell is about 3 years. And they've been averaging, third-party documented with Preqin, they've been averaging about 64% IRR. And that's net to the investor, Sam.
Net to the passive investor.
Yeah.
Yes. And this is one of your operators, one of your portfolio?
Mm-hmm. Yeah.
Okay.
And I mean, and the deal I described earlier in Louisville, I'm not saying they're all that good, but it's fairly typical. I mean, that's the kind of deals he's getting. And the way he's doing it, speaking specifically to your question about mom and pop, Sam, the way he's doing it is, a lot of people talk about having a really good direct mail campaign, or a group of people calling off-market, owners. He's actually doing it. I mean, he's doing a really good job. He's got a phone bank with 4 or 5 full-time people calling 100 to 200 people a day on their cell phone, home phone, work phone. And he's they're talking to these off-market self-storage and mobile home park owners, and they're turning over a potential deal or 2 or 3. I mean, really good ones like that every week. And so he's able to choose from those and maybe close on, more or less almost 1 deal a month.
Paul, what are we missing? I mean, just within this group here, there's a lot of folks that have deep residential, just real estate experience investing. We know that Zamsel has sold his apartments and has a listed company now. We cited that Wall Street Journal article. There's at least 2 very high profile companies focused on mobile home parks. If it's that good, what's really the catch? Is it really getting the deal? Is it expertise? Yeah, I feel like I'm missing something here.
Well, mobile home parks they have a stigma. I mean, my mom always told me nothing good happens at a trailer park. And, that was the stigma for years. And so the cap rates have traditionally they've been kind of a redheaded stepchild for investors. And Sam Zell was years and years ahead of most of us seeing this. And so Sam Zell and others were investing in these, and they were overcoming that stigma. It used to be people in a real estate investment group would be, they would look down their nose at somebody investing in mobile home parks. But now there's a lot of interest. I wrote a couple articles on Bigger Pockets a few weeks ago about mobile home parks, and I got an overwhelmingly strong response with people wanting to talk to me and wanting to ask questions and wanting to learn more about mobile home park investing.
Okay.
I think one catch to it now is it's catching up. And I think Arun would probably agree. It's sort of catching up to self-storage, and self-storage is sort of catching up to multifamily. In other words, the cap rates are shrinking a lot. It used to be you would look for deals 10% cap rate or higher, which means a really low price, right?
Mm-hmm.
And then you would hope to get deals in the 12 to 15% cap range, I've heard. Well, now the deals are more like a 6% cap rate, and you're hoping to get one like 8%. And often, like the one we just closed on a day or two ago, I think it was yesterday, with our operating partner, he said, I think that the cap rate going in was 5%, but it was so poorly managed that he can get it to 8% very quickly, as in almost immediately.
I see. So when your operators acquire a deal, the cap rates don't sound much higher than some of the multifamilies that we're looking at, right? But you're saying the chance for value add is just much higher and hence more attractive.
Yeah, so 93% from what I read of multifamily 50 units and above, which is all we were trying to acquire, is owned by, corporations, companies, people who already really know what they're doing, and they've already added value, and maybe they've wrung the value out of the asset. But 90% or so of mobile home parks and perhaps 70% of self-storage is owned by independent or even mom and pop owners who don't have the knowledge and the wherewithal to maximize value. They're often just holding on, a lot of them in their 70s or 80-year-olds or older, and they're just holding on, and trying to get out. And they can't believe that you're going to offer them, let's say, $7.1 million for an asset that they might have thought was worth a couple million originally.
Mm-hmm. Okay. Do you guys pay a dividend? Is this a cash flow as well as appreciation play?
Yeah, so there's cash flow along the way. We just actually got a bonus from one of our operators, even in the middle of this COVID crisis. He actually gave us extra 1 or 1.5%. I just got it noticed today. But typically, we're looking at cash flow of between 5 and 10% along the way, and we're targeting 15% total annual returns, at least within my fund. But like I said, our operators have been doing somewhat better than that, quite a bit better.
Gotcha.
We'll see how it goes with COVID. I don't know.
Okay, so stepping back, for folks that want to be passive and just to invest into this asset class, it sounds like it has a lot of features of investing in multifamily, but potentially better returns if you have the right operator. The question I would have is, if I'm an investor, is to invest in you or invest in an operator, where to find them, and then there's also the accredited investors, right? With at least 2 pretty big name listcos doing primarily mobile home parks. Clifton might know this. I'm not sure if they're trading at a discounted NAV right now, but can you talk about investing directly into an operator passively versus investing into your fund, which is really investing in several operators, versus just buying a stock, one of Zamzel stocks or the other one? Can you kind of
Yeah, there's a lot there. So if you invest directly, our goal was as a fund to provide diversification across assets, geography, operators, even strategies. So when you invest with us, when we wanted to set it up, so we have those 10-year and beyond holds, but we also have the 3-year flipper I mentioned, who's getting a lot of profit quickly. And so we're trying to get a diversification across all of those. Another benefit of investing in a portfolio rather than one deal at a time could be that you're getting a diversification across time. And what I mean is, somebody who invests with us in December of 2020 is going to get that $7.1 million asset that we closed on February 21st. They're going to get another one in Iowa we closed on in May, another one that we closed on yesterday, June 1st or 2nd, I guess it was. So they're going to get those that are already largely de-risked. because our portfolio goes back in time and forward in time. The disadvantage is going forward in time, you don't know what we're going to do next. So you really have to trust us because you don't know where we're going to invest next. But I mean, the track record's kind of where you look at for that. Tax benefit wise, I think that the tax benefits clearly of direct investing are superior because you get a K1. And so as a direct owner with a K1, you're going to get all the tax benefits I mentioned earlier. That was only one of about 10 tax benefits we as multifamily or self-storage or mobile home park investors get. So we get all that. One advantage for a REIT would be, like you said, they're undervalued right now. And you're not going to get that as often with a private operator. I mean, you sort of get undervalued when I guess you're buying from a mom and pop. But with a REIT, you've got the fact that it's, I mean, whether it's good or bad, it's subject to the mood on Wall Street, the war in the Middle East, the COVID, all the things like that. It could be subject to a CEO scandal like at Uber or WeWork. I mean, there's all kinds of things that can be subject to, but the benefit is you're liquid. I mean, you can come and go as you please. Now, for those who really want to be liquid, I would actually say this. The greatest investor that I know of, Warren Buffett, says it's not an advantage to be liquid. And he says it's the best way to lose money in equities is to use your liquidity to get in and out quickly. So, and I think everybody here knows that Buffett's thoughts on that probably.
I think he's referring to men. I think studies have done that men tend to be very trade oriented and then hurt their returns, whereas women tend to be more patient and make more money longer term.
Yes.
That's probably true. That's probably true.
That's probably true. Absolutely.
So there's a couple of questions from the audience. To what extent is rent control an issue with mobile home parks? What are the cities with the bigger problems and less problems in rent control?
Yeah, I think that's going to be more and more of an issue as time goes on, as we see more areas doing that. We saw what Oregon did. Of course, Oregon's rent control, I don't think it's that oppressive overall, but I hate to say that. But California, we're flying to Sacramento in about 3 days to look at 2 operators. One of those operators has a bunch of deals in California, which is that'd be brand new for us to invest in a deal in California. And we're pretty wary of that because of rent control. I think it's a big question, and I think it's going to be something that is really likely in mobile homes. I mean, I don't ever see that happening in self-storage, but who knows? So I think it's a big deal, and I think it's something we need to be careful about.
Okay. Question on rezoning. As a lower end use of land, is there opportunity to sell land as a different use? How hard is it to get out of that business, if the land appreciates and moving the tenants out to redevelop, I suppose. Yeah.
So you're talking about zoning down to a mobile home park, not out of it, right?
I think upgrading to something a bit more fancy. I think that was the question.
Oh, yeah, that's much easier. Yeah. So NIMBYism, according to that Wall Street Journal article by, I think it was Ryan December, he said NIMBYism, not in my backyardism, causes people to hate parks. And yeah, people love it when you rezone. In fact, that's why there's we believe there are about 100 mobile home parks going defunct every year in the US, and only about 10 new ones being created. And they're usually created in really rural areas where you wouldn't even want to invest anyway. And so, yeah, as far as upgrading, upzoning, I think they call it, yeah, that's easy to do. To get zoned for a mobile home park anywhere near where you'd want to be, like near a city, I can't imagine making that happen.
Okay. Paul, there's a request. We've been focused probably my own into mobile home parks. There's a question to talk about self-storage. Can you talk about the cap rates, IRRs, I guess, relative to mobile home parks and other asset classes that you're seeing, and why that's attractive?
Yeah, so I just wrote a book called Storing Up Profits, Capitalizing on America's Obsession with Stuff by investing in self-storage. That's the first time I've ever said that title right.
Congratulations.
Yeah.
So it's out. It's out. Okay.
Yeah. So if anybody wants to get a copy of that, I've got a summary of that in ebook form. You can write me or write San and get that. If you actually want a copy of the book, I'm not really like generally sharing that because it's actually at a publisher waiting to hit the press. But I'd be willing to share it with you, San, and if you guys want to share it here. It's about a 200-page book on self-storage. Self-storage is amazing. It's you know, it works well. And again, there's caveats. I mean, it's overbuilt terribly in some markets. But it works well in good times because people are, you know, they're filling up their Walmart card and their Amazon card, and they're growing. And it also works good in bad times because in bad times you got the 4 Ds, which if I get them right, it's death, dislocation, downsizing, and divorce. And when people are downsizing from a larger home to a smaller one, for a very small percentage of their income, they can rent a storage unit and keep their stuff and not have to get rid of it. And a lot of people do that. I mean, when COVID hit in March, there was a huge uptick in self-storage as people, college students specifically, didn't know what to do with their stuff. They weren't sure if they should keep it in their dorms or take it back home for the summer. And so they quickly rented storage units, especially the kind that were professionally run and you could go in without meeting anybody. You know, there's no face-to-face interaction in a really well-run self-storage right now. They're sticky. When I have a $1,000 a month apartment rent and I raise your rent by 6%, you may do the numbers and say, gosh, that's $60 a month, $720 a year if I sign this lease. But if I'm renting you a self-storage unit at $100 a month and I raise it 6%, you're probably going to think, I don't like $6 a month, but I'm not going to spend a Saturday, rent a U-Haul, get my friends together to move my stuff down the street to save $6 a month, especially since I'm probably going to leave there in 2 to 3 months anyway, as soon as I can get the time to clear that place out. Mm-hmm. That usually doesn't happen. But so self-storage is really, the tenants are very sticky, sort of like they are in mobile home parks. You know, mobile home parks, they're sticky because people honestly don't, want to spend $5,000 to move their mobile home. Well, self-storage, they typically, just don't want the hassle of moving out. And so they stay. There's a lot of other great things about self-storage. I will tell you returns, they're probably somewhat similar to mobile home parks. There's some more obvious value adds in self-storage. One would be a real simple one would be adding U-Haul. So if you add U-Haul or Penske truck rentals, imagine you bought a self-storage facility for $5 million. Let's say that's $3 million in debt and $2 million in equity. You can add Hertz or Penske, you can add U-Haul or Penske truck rentals, and you can make, let's say, $4,000 a month. Well, that $4,000 a month is $48,000 a year in commissions from U-Haul. Divide that by a 6% cap rate, and you just added, on paper, $800,000 to the value of your facility. Mm. Well, I mean, $800,000 on top of $2 million in equity, you just added 40% to the value of your equity with one change. Other changes would include selling locks, boxes, tape, scissors, charging late fees, just getting delinquencies out of there. I mean, we invested in a Grand Junction, Colorado self-storage facility where the lady had 80% occupancy, which isn't horrible, but she had 80% delinquency as well. 80% of the people weren't paying or were paying late. So when our operator got in there, he immediately cracked the whip, raised rents 25%, evicted everybody. By the way, it's really easy to evict in self-storage because you're not evicting people. Evicted the people he needed to, and he got collections up from 20% up to 94 or 95% within 2 or 3 months. Well, the value of that facility has almost doubled, which means the value of the equity has almost tripled in about 1.5 years since he took it over. And again, that's fairly typical deal for this guy. You've got to find the right deal though. There's a lot of metrics that need to work. You need to check the number of square feet of self-storage within let's say a 3-mile radius. You want to be under about 8 or 9 square feet per person. If you're way lower than that, like we were in Ramsey, Minnesota, which is outside of Minneapolis, we invested in a ground up there because there was only less than 2 square feet of storage in a 3-mile radius in this booming suburb. At the same time, you want to be on a main road. You want to be very visible on that main road, and you want at least average or hopefully higher than average income in that 3-mile radius. Those are some of the things we look for in metrics in self-storage.
Okay. There's a question about property management as it relates to the mobile home parks. Are there PMs out there that can do the heavy lifting, or do you have to build your own team?
You know, multifamily, I'd say of these 3 asset classes we're talking about tonight, multifamily has by far the most mature and sophisticated property management. I would say self-storage would be in the middle and mobile home parks the least. There are, like I said, I'm going to Sacramento in about 9 days to visit a company, and they actually have third-party mobile home park management, but I don't see as much of it, but it is out there.
And so in your portfolio operators, they build their own capabilities?
A lot of them build their own. Yeah, the ones we invest with have mostly to date, actually all to date, done their own property management.
Okay, so that is a big difference, because you're right. You know, once you get to 50, 60 units in multifamily residential, it's much easier with the PMs. Yeah. Right. There's a couple of questions, Paul, about your fund. Maybe you can talk more about it. You're in Fund 2 now, and I think growing. Tell us how it works, the fees, what are you investing, how you allocating the capital, what are the minimums, and how potentially some of us can get involved.
Sure. So one of the things I didn't want was to have all these fees that cost, you know, made it more costly for an investor to invest with us than without us. And that sort of made me pause for almost 2 years about doing a fund. But what we found was that a lot of these operators are willing to give us a much better deal as a very large investor than we would get otherwise. So without diving into great detail, for example, if you invested with our favorite operator, you would get an 8% preferred return and a 60-40 split. We get an 8% preferred return and an 80-20 split. Now, we have a 1% fee on the front, 1.3% fee on the front end and 1% a year management fee. So we have to overcome that to break even with their returns. We break even with them at about 19%, meaning if the returns, this is the guy who's been returning 64% average. If he comes in at below 19, it's going to be better for you to invest, somebody to invest directly with them. If he comes in at 19, we're about even. Above 19, it's slightly better with us because of that. We have another operator who has a 50-50 split, but he gives us a 70-30 split. So things like that. We have a 10% preferred with that operator instead of an 8. Things like that just help. Our fees, like I said, are about 1% a year. Then we have an 80-20 split above that, above the preferred return. I could dive deeper into that. But that's kind of a quick overview.
Yeah, I think to summarize, you're because of volume, expertise, relationship, you're getting better fees than a typical investor into the operator. You charge fees on top of that, but you say it nets out eventually.
Yeah.
Yeah, I see.
$50,000 minimum, by the way, and it's for accredited investors. Just to finish answering your question.
Yep, understood. Okay. And how you allocate, what's your fund size now? What's your target for the Fund 2? And how do you allocate that in terms of geography, in terms of asset class?
Yeah, so we have a growth fund that is not one of those 2 funds, and we're investing in ground up deals and steep value add. Target on that's 10 million over 2 years. Fund 1, the income Fund 1 last year, our target was 10 million. I think we hit about 15. Income Fund 2, our target is 15 million, and in We opened for the first time February 27th. In March, at the end of March, we made our only investment so far in a group of 22 assets. And that was $6.5 million. So that we're 6.5 of our 15 in the first quarter, our goal for this year.
Okay. Again, in the multifamily world, I think all of us are meeting quite regularly and trying to assess what happens with COVID. In the self-storage in the mobile park world, you kind of touched upon it a bit earlier, Paul, but maybe you could expand a little bit. Where do you see this going in terms of obviously your view of the economy, and then how aggressive you and your operators are in these two asset classes, and why?
I want to be really clear here that I'm almost certainly going to be wrong. The question is by how much, but you know how forecasts are, right? They're all wrong.
Mm-hmm.
But I don't know what I don't know. This is unfamiliar territory, but what we have is record unemployment in record time. We have record printing money. We have record national debt. We have record commercial debt on many levels, record consumer debt on many levels. We have so much, and we have a pandemic that could repeat itself. There's so much we don't know, but I think it's very, very likely. Well, let's put it this way. Howard Marks said, I just finished reading his book, Mastering the Market Cycle, which I highly recommend. I know you've read it, Sam. I just finished it for the second time, and he said in there, I noticed, I hope I never see another downturn in my lifetime like 2008. Now, he spent a lot of time amassing funds to do a distressed debt fund, and he was plowing $500 million a week towards distressed financial debt and distressed financial assets in the fall of 2008. Well, like I said, he said in the book, I hope I never see that again. Well, he's now raising a much, much larger fund for distressed debt this time. So I think you guys are incredibly well positioned. I think multifamily is going to come around, and I think we could go over some numbers if we had time. I think multifamily is going to be an incredible opportunity. So many people overpaid, and so many people, I think, are going to have trouble in the coming years. We could take the math and tear that apart and tell you why. But I think multifamily is going to go. I mean, again, none of us want to see anybody hurt. None of us want to see any investors or operators lose their deals. But there's some people who were pretty irresponsible in the last 5 years that might lose their deals. Same with self-storage and mobile home parks. I just think we're going to see more of the same in those areas where there are mom and pop operators who are selling and will be buying.
Okay. So net, your operators, not just guys, your operators, much more aggressive now, given that it seems like you're saying the demand it's gotten stronger, or seems to have gotten stronger.
I'd like to say that we're more aggressive, but honestly, I wouldn't say that. I'd say we're about the same. We're doing the same thing we were all last year and the year before. When I say we, I'm talking about my operating partner who's got his 4 or 5 guys on the phone 8 hours a day calling mom and pop operators. And now where we saw the fact that they were mom and pop meant that there was a lot of upside. Now we're shifting our view to say, okay, there's still a lot of upside, but we're seeing this as a downside buffer protection as well. If we can go in and raise the net operating income, like I mentioned, just by passing water and sewer back to those tenants, if we can raise the net operating income by $213,000 on that park in Louisville, well, that's not just a nice profit. That's also protection against an expanding cap rate, expanding collection problems, and the potential that we won't be able to raise the rent like we planned by $50. Maybe we can't. Well, we've got this buffer as a protection. You guys all know about the DCR or DSCR, the debt service coverage ratio. That's my favorite measurement of safety. You know that banks like to see 1.25 or 1.3, so 25 or 30% margin of safety above your net operating income, your ability to service the debt, in other words. Because of buying from these mom and pop operators and leveraging fairly, not too aggressively, we're actually able to see 133% margin of safety, meaning a 2.33% DSCR in our portfolio right now.
Okay. By the way, Paul, besides being a fantastic writer, as I said earlier, I love reading his stuff, and well published. Also, is very well connected in the publishing world. So thanks to Paul's introduction to Morgan James Publishing and his endorsement, they were willing to pick up my book. So thank you for that, Paul. Hopefully,
I'm so glad.
Yeah, I'm nervous. I got to live up to expectations. Working hard on that. And part of the book question is really more, again, bigger picture asset and portfolio allocation. So Paul, my question to you, and I realize that this would be subjective, is you're sitting on, I don't know, $1 million retirement account, either for yourself, long-term investing, you want appreciation, you want passive, maybe you're investing for your kids. How do you allocate that money? Across all asset class, how would you, and obviously, how much of that would you put in self-storage and in the mobile home parks?
You know, we're leaning a little more on mobile home parks right now. If I had to allocate it for me, I would allocate it, if it was just those two asset classes, I would go about 60-40 or 65-35 in favor of mobile home parks. However, in 2021 and 22, I'm going to plan on investing heavily in distressed debt as well, not only in these asset classes, but in some others.
Maybe you can talk more about that. Like what type of vehicles? Are these direct deals?
Yeah, so direct deals from regional or local lenders. The quick math on this is, let me see if I can do this. So let's say I think what really likely went wrong in the last couple of years is overvaluation of assets. Not that the income, the rents weren't what they are, and not that the value adds couldn't be what they are, but just the fact that people just paid, took risks, assuming that appreciation would continue and that 5.5% cap rate would eventually be 4.5%. I mean, LA's there, New York's there. Why can't, Birmingham, Alabama be there? Well, I don't think that's the best way to think. But anyway, I think let's just do the quick, super simple math. Let's say someone bought an asset, they overpaid for it. They paid $4 million for a multifamily property. Let's say that's 50 units at 80,000 per unit, if I did the math right. So that's $4 million. Let's say the cap rate was 5.5 and it expands to 7. So that's 1.5 points. I don't have the math on that. It's actually a little tricky to do the math. Try it, you'll see what I mean. But basically that's about a 21 to 25% decrease in value of that property. Let's say also, like Green Street says, there's an 8% drop in net operating income from 2019 to 2022. That's what they're predicting. I know other people are predicting something totally different. I'm just using that number. So 8% decrease in the NOI. So you've got the numerator dropping 8%.
Yeah.
Maybe I said 7, but let's say 8. And you've got the denominator working against you to the tune of 25%. The total, and I know this doesn't add up, but if you do the math, you'll see what I mean. The total decrease in the value of that property is about 28%. Well, that means that you're below 3 million on the value, and commercial real estate is unlike a lot of other asset classes in that you have to pay the piper. You have to refinance every now and then. And so let's say it's a poor operator. Let's say they're high on delinquencies. Let's say they're low on collections, obviously. Let's say they're not able to raise the rent. Let's say their vacancy goes up and they've missed some payments. Well, now they've got an asset where all the equity has been sucked out of it. I forgot to tell you, I'm sorry. They got a $3 million debt on a $4 million property. Well, now the value of the property is, we're down the road 4 years. The value of the property is now 2.9 million. All the equity in the past is gone, evaporated. They're going to have to get a lot more equity that's going to be very low value just to try to refinance. And now they've got lenders who are, number one, tightening their requirements. Number two, this person has bad credit and looks like they might even default. That's a bad deal. So that bank might want to, all that is to say, that bank might want to move that loan off their books, and they might be willing to part with that loan pretty cheaply. So we would go to the bank and we'd say, hey, we'll buy that debt for, and please don't argue with me, I'm just using an example, $1.5 million, 50 cents on the dollar. We buy it for $1.5 million. We go straight to the operator and we're Mr. Nice Guy. Hey, we know you owe $3 million. You've got to refinance in 9 months. We're going to let you out of this for $2.25 million. Okay. So for $2.25 million, you can get out. This is your chance to save your deal. And let's say in 9 months from now, they are able to refinance. They pay us $2.25 million. We just made a 50% return on, in 9 or 10 or 12 months. And if you split that half debt and half equity, we just made 100% return on equity in about a year. That's how it works. Now, if they can't refinance, let's just say they continue to, go downhill, they give up and they just walk away almost. Well, now we've got a $3 million-ish asset for $1.5 million that we paid the bank. And now we hopefully are going to get great property managers in and ride that back to $4 million over the next several years. That's how distressed debt works in summary. And that's very simplistic.
Okay. That would be a separate fund, a separate product, right? It's not.
It sure would. It'd be completely separate. And I don't anticipate these deals coming about for a minimum of another year, but possibly 2.
Gotcha. Paul, it's past 9. I know you just came back from holiday and you've got another interview after this. Perhaps you could share with us a bit more about the book, how we can get in touch with you and learn about the fund, or just ask more questions.
Yeah, well, I really didn't come to recruit any investors at all. However, if you want both of my ebooks, you can get them at wellingscapital.com/resources. That's Wellings Capital, WELLINGSCAPITAL, wellingscapital.com/resources. If you actually want the full, if you're really interested in self-storage and you can't sleep at night and you want the full 200-ish page book, my publisher said I could share some draft copies.
Great.
You can get that by emailing me. You can email paul@wellingscapital.com.
Great.
And
Great. I have read those ebooks. I'm on Paul's newsletter, and he doesn't spam you, Paul. I think you send 1 to 2 a month. But as I said earlier, I love how you balance content with efficiency and making it even for a dumb guy like me to understand what you're saying. I really love your writing, and please keep that up. I would suggest those of us interested in those asset classes do subscribe to Paul's emails. Yeah, appreciate that.
That's so kind of you.
Yes, and again, thank you so much. I appreciate it. I know you just came back, and you've got another one coming up. So
I'm full of energy.
Also, yes, you are.
I'm going to the West Coast. They have a 7 o'clock meeting, so it's 10 o'clock our time.
Gotcha. Okay, well, we'll put this up on YouTube. We'll as soon as we hire someone, we'll also make this into a podcast and summarize the contact information for Paul as well. Paul, thank you so much. Always good to learn from you.
All right, San, it's been a real honor. It's great to see all you. Arun, I'd love to talk to you more if you get a chance. You got my email address. And
yep, absolutely.
Thank you, John. Thanks, Dave. Thanks, Chloe. Thanks, everybody, for joining this evening.
All right, Paul. Thank you again. Good night.
All right, take care.
Guys.
Good night.
Thank you.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.